Okay, we got the sign, we can start. So welcome everybody. Today we'll talk about what happens tomorrow to US inflation figures, consumer price index. These are figures for July. Just a quick presentation of myself. I used to be a retail trader and a computer programmer. Many of you know me from my days at Forex Crunch, a site I founded in 2008, and I joined FX Rate 2018. And my focus in general is on fundamental analysis, which I'll talk about today. I'm leading FX Rate's premium content offering, and I guess some of you already know me from there, from the Discord channel, from everything. And before we begin talking about inflation, just want to say that we now have a 50% off on annual subscriptions to our premium service. It's basically 6 months for free. So just for today, you can see our exclusive traders community. We get lots of positive feedback from there. And you can access myself, my colleague Tomas, an expert in crypto and on high-level technical analysis. We provide daily trading alerts, signals, strategies, economic data, and events. You can leverage our actionable content. Here are a few of our testimonials. Just what I need to know when I need to know it. Excellent insights. You really inspire me. So yeah, I guess we do less of the inspirational stuff and more of the practical stuff. And we're geared towards traders. Yeah, we have accumulated some 20 years of experience to back us up, so we do know what we're talking about, and you can take advantage of our actionable content, learn our best practices. We provide also educational content, and you can follow our trade plan and learn by doing, and just be part of our exclusive community. Let me share here in the chat the link to access. To sign up to the premium section. Where did I lose it? Here it is. Okay, so I'm sharing it with you in the chat. You're welcome to sign up, and I'll begin really shortly. What you came here for, talk about inflation. So here we are just for today. Yeah. Okay, so now that we've done this short pitch, this is what we'll talk about today. Where markets stand. We always need some context when we talk about markets. Which kind of inflation counts? We'll talk then about 5 scenarios for trading this CPI figure, and you're welcome to ask questions, whichever you like. So where are we? The big question for investors is, have we reached peak inflation or not? If you look at this picture that I've selected carefully, it's not that clear, so that's where we are in markets as well. It's unclear if we're there yet. Why is it so important? Because if we've reached peak inflation, that means we've reached peak interest rates. Markets hate uncertainty, not knowing how high inflation is or where it will go and how high interest rates will go. Because if you have high interest rates, this is courage to invest in stocks, okay? And if inflation has peaked, this fog that you see here in this picture, I really want to be there in this cool snow. Then you can invest in stocks with more confidence, okay? So there are signs of peak inflation. Let's talk about the positives. I mean, inflation going down. So we're seeing oil prices drop quite gradually. We're now just below the levels we were in February, just before Russia invaded Ukraine. So we're seeing also the University of Michigan's long-term inflation survey back below 3%. Why is this figure important? Because the Fed says it's important and markets listen to the Fed. Okay. And another reason is that China's zero COVID policy means empty parts of Beijing, empty parts of Shanghai, lower economic activity, less consumption in China. Chinese people, the biggest country in the world in terms of population and second largest economy, if they're consuming less, then prices fall. Another thing, prices fall, is another survey, the ISM prices paid figure. We got these figures last week. Both the manufacturing and the services sector, we've seen figures drop. Okay, so businesses expect inflation to fall. Consumers expect inflation, at least in the long term, to fall. So these are good signs. And reports from Long Beach, Tianjin in China, New York, Amsterdam, we're seeing fewer ships there in queues. Okay, so these supply chain issues are moving away. Yeah, and of course there is fear of inflation. So that's another sign to expect. We are there yet. We already see peak inflation. If we just look at GDP, gross domestic product, in the US, it shrank for 2 consecutive quarters. which is, according to some definitions, well, in a recession. Now, there are other signs that don't point to a recession. Won't get into the political and the economic thing, but in any case, for those looking for signs that inflation has peaked, such as stock markets, you have that sign as well. And on the other hand, there's no peak inflation because you cannot see the end of this queue in the airport. I recently traveled here from Barcelona to Dublin, and the queues were huge, and there were lots of suitcases piled there. People want to fly. People are ready to spend their cash. Restaurants are also packed, not only here in Barcelona, but also in the US. We're talking about US inflation, and companies are still paying money, in some cases, not ever, just for people to come to interviews. Yeah, if you want to work for McDonald's in the US, in some places, you'll get $50 just to show up for an interview, because not everybody shows up to interviews, okay, because this labor market is steaming hot. Okay, just on Friday, we got the Nonfarm Payrolls, the US jobs report. We got 528,000 jobs gained. It came on top of an upward revision, and yes, companies are willing to pay more. 5.2% annual wage gains. It's not too bad under inflation, but it's still way above average. So these figures came out above expectations. Now, how are markets reacting? In stocks, it's clear it's fear of missing out. For over a decade, stock investors had this tendency of buying the dip. Each time there was some bad news, well, it's going to go up anyway. Let's ignore it. Let's just buy the dip. So it's back. We had a 9-month pause from November, I would say, to August, or maybe only 7 months, 8 months. Anyway, we had the sell the rally. Bad news was just a sign of getting more bad news, but things have changed. These initial signs of peak inflation and the fear of missing out. If one trader is buying, probably knows better than I do. So let's buy stocks as well, and stocks have gone up. And buy the dip and for more back. And so our meme stocks, we have AMC, GameStop, Bath and Beyond, and also new kids on the block like this HKD stock. Everything's going crazy. Okay, but when we're talking about the US dollar is still strong. Usually when stocks go up, the dollar should go down, or at least if you expect inflation to have peaked, you expect interest rates not to go much further higher, you expect the dollar to fall. But the dollar is still relatively strong. It's still the cleanest shirt in the dirty pile, because when, contrary to stocks, when you buy the dollar, you have to buy the dollar, or you sell the dollar, you have to sell the dollar against a specific currency. And which currency will you go for? I mean, we can get into long discussions, but just in short, here in Europe, we're under the threat of a Russian gas cutoff. Britain as well. This zero COVID policy in China is hurting Australian exports, and even the Canadian dollar is suffering from a bit of falling oil prices. Okay, so what will you buy? What will you sell the dollar against? Okay, so after this discussion about have we reached peak inflation, haven't reached it, it's time for hard evidence. Survey data. Well, we saw stocks reacting to that, but not the dollar. But hard evidence, not surveys of what people say they will do, but what they actually do, what they're ready to pay for. Inflation. So CPI, Consumer Price Index, is not the figure the Fed is looking at. The Fed is looking at PCE, but PCE is only released at the end of the month. The CPI is more important because it's released now in the middle of the month and not at the end of the month. That's hard evidence. Okay, so let's talk about what kind of inflation matters. The price at the pump. This is a chart I got from GasBuddy. If you're in the US, you're probably following this website, and because you probably drive a car. These are gasoline prices. They dropped a lot from the peak, okay, from just surpassing $5 a gallon. They're now at $4 a gallon. This drop began in June, wasn't seen. The drop in crude oil prices began in June, was only seen in July. Now we're going to get it. So this is headline inflation. The price at the pump, Republicans are talking about it. Biden is worried about it. That's why he released oil from strategic reserves. That's what everybody's talking about, and we're expecting to see it down. Okay, So Biden will take a victory lap after Republicans took a victory lap beforehand. That's politics for you. So on the headline inflation, which includes everything highly influenced by gasoline prices, I should say, fuel, petrol, depending on what is your preferred type of English. Anyway, that has a huge impact on overall inflation. So in June, overall inflation jumped by 1.3% just 1 month, during 1 month in the US. Now it's expected to rise by only 0.2%, okay? And the yearly figure is expected to slide from 9.1 to 8.7%, still high inflation, still way above average, way above target. But markets don't care about the price at the pump. Why? Because the Fed doesn't. Because the Fed cannot control how much oil is produced in Libya, how much oil comes from Russia. If Iran is able to pump oil outside, to China, despite sanctions, how much is produced by shale companies in the US? And it can control also the Russian blockade, which is now easing of grain, of food from Ukraine. But the Fed can control other kinds of inflation, basically prices of everything else through demand. Because when you have higher interest rates, you're encouraged to save money. You get more if you save money in the bank, and less encouraged to buy stocks, less encouraged to buy new stuff, and you're also discouraged to lend money to buy a new car, for example. Okay, so this is the inflation that the Fed can control. Now, core inflation, that's what we'll focus on, and we'll focus on monthly core inflation. We're expecting it to rise 0.5. I'm talking about the economic calendar, and that's the consensus, against 0.5% in July, the upcoming report tomorrow, against 0.7 in June, okay? If we look here at this table, which I got from the FX Read, we're seeing it that in the past 3 months it beat expectations. I think that doesn't change expectations, that expectations are at 0.5%. But just looking at this 0.6, 0.6, and 0.7 for 3 months, if you annualize that, it's 8% annualized, which is extremely high. Okay, so we're expecting a small drop in monthly core CPI, a small rise in yearly. Yearly figures are not that important because for yearly figures, you take last year's inflation figures into the calculation, and that's old news. What matters is almost exclusively the monthly figure, because the Fed began raising rates. This is the interest rate in the United States only in March. So now we get figures for July, and in the yearly calculation, the figures from July 2021, they drop off. Who cares about what happened last summer? What's important is some kind of a change in what we're seeing now in inflation. Okay, so 0.5 is the expectation. Now let's talk about 5 scenarios for reactions in markets. Okay, so let's go. Let's go for the as expected figure, 0.5. Okay, still no peak in inflation. Here's a picture I found of cresting, something I, as an avid hiker, have done in the past. You reach the peak. You think you've reached the peak, at least, and then you keep on walking on high ground. You don't go down. It's going on the crest. Maybe it'll be a bit higher, as you can see here in the picture. Maybe not. So it's still no peak, but at least some kind of relief, and I guess some kind of the same reaction in markets. So we get stocks up, and also the dollar up. Stocks because of this fear of missing out, FOMO, and the dollar up because it still means interest rates will go up, and this kind of cresting. Okay. Now I expect that if we get this 0.5 as expected, that we'll also get some kind of we'll begin looking also at yearly inflation. That means it's expected to rise in this case to 6.1, but perhaps there was downward revision for last month. If it was a downward revision, it's a bit better for stocks, a bit worse for the dollar, and if it's an upward revision, it'll do the opposite, but I don't think it matters that much. Okay, this is the baseline scenario that will get 0.5, we'll get stocks edging higher and the dollar as well. Okay, another scenario is just 0.1 higher. Okay, so 0.6% on core CPI. That's a bit hot. Inflation is still strong. I expect, as always, the most straightforward response to be in dollar yen. It's the currency pair that best reacts to US data. Why? Because both the dollar and the yen are safe haven currencies. So they offset each other. There's no good news is bad news like we saw with non-farm payrolls. So we get a straightforward response. Dollar yen is also correlated with yields. Yields reflect expectations for the Fed. But if we get inflation that is a bit hot, we get, okay, US dollar yen going up. And I expect the euro and the pound to be a bit more under pressure than other currencies because of Russia, okay? And I expect commodity currencies to stabilize because the dollar will probably respond strongly against the yen, against the euro, against the pound. Stocks will fall a bit, but might stabilize. So I expect commodity currencies that also follow stock markets to stabilize alongside stocks, and especially the Canadian dollar. Why the Canadian dollar? If you remember what happened on Friday, we got a very strong US jobs report, very weak Canadian jobs report. We got Canada reporting for the second consecutive month that it lost jobs. That's bad news for Canada. Still, the Canadian dollar held up, and that came despite the drop in oil prices. Why? Because the American and Canadian economies are very, very correlated. Canada exports something like 75% of its exports to the United States. So I expect the Canadian dollar to stabilize, to recover, okay? And also the Australian dollar and the Kiwi to a lesser extent. Okay, let's go now for extreme scenarios. Steaming hot and spicy inflation, bad for American consumers, bad for the world. America as the largest economy exports inflation. In this case, I expect markets to shoot first, ask questions later. I expect, well, it's a nasty surprise. I expect stocks to fall. It means even more interest rate rises, maybe 100 basis points in September. Now markets are expecting 75 basis points. To shoot first, think later. It's a low probability scenario. It's very good for the dollar across the board. I think all currencies will fall against the dollar. Stocks will suffer. That's a straightforward scenario. Very low probability, but when if such a scenario happens, it'll be crazy. It'll be a very straightforward response, like the straightforward response we've seen with the dollar on Friday in Nonfarm Payrolls. Okay, now let's look at other scenarios. Let's look at what happens if it's a bit cold. 0.4%, just a small miss. Just 0.1 below expectation. That'll be cooler temperatures like this nice springtime picture, and it'll be cool also for Putin. Well, not so cool. Anyway, I expect stocks to rise again. Another sign of peak inflation, this time from hard evidence. Not a big difference, 0.4 against 0.5, but good enough for this FOMO mood, this fear of missing out. Investors will jump on stocks. They don't need too much to rally in any case. And I expect dollar yen, again, straightforward response to fall with yields, and the antipodians, it's a nickname for the Australian and the New Zealand dollar, to rise quite nicely. However, I expect the euro and the pound gain a bit of ground against the dollar, but not that much. I expect them to suffer just a bit because of the fear, ongoing fear, nothing new, that Russia will cut off gas supplies. Both the UK and the Eurozone are already suffering, so I expect more suffering to come. Okay, yeah, now let's look at another low probability, high risk scenario, which is super cold inflation. Actually, we got this figure not that long ago of 0.3 in core CPI, so it's not something we can totally rule out. So yearly core inflation will fall in this case as well, so we'll get sort of another chain reaction. I mean, not only not only monthly core inflation is down, but also yearly core inflation is down. So that's good news for Americans, for the world, not so much for the dollar, but very good for stocks. If you annualize 0.3, if you multiply it by 12, it's not a precise calculation, but more or less you'll get around under 4% annualized core inflation, down from that 8%, and down from, and showing that the Fed is beginning to win this war. So in this case, I expect the dollar to be dethroned to, again, a shoot first, think later response, dollar is going to suffer a lot, and we're going to have a party in the USA and US stocks. Okay, again, low probability, high risk scenario. Okay, before we open the floor to questions, I want to say once again, it's a huge event. Every 0.1% here matters, okay? Every change. I think we're going to get markets moving a lot, even if it comes exactly as expected, but every deviation of 0.1% to one side or the other will trigger a big response. I would dare to say it's going to be bigger than non-farm payrolls, okay? More volatility for sure. Finally, last Friday, we got lots of volatility in non-farm payrolls, but it's not always the case in recent months. Those of you who've been trading, we've seen lots of choppy action, but no clear movement. So I highly recommend you all, something I repeat also in the premium service, is to lower your leverage, trade with care. Also in these kind of events, liquidity tends to dry up just before the event, so money is sort of sucked out of markets. I mean, open positions are just vanish, and that means that every small bid or ask, every small trade can trigger a big response in the dollar, in stocks, anywhere. Okay, so it's a high risk environment, and liquidity is already low. Okay, so we're talking about the summer, we're talking about heat. At least here in Europe, many people are on vacation. Okay, so that means there's less money to move around, and movements can be a bit sharper. Yeah, and the event is on Wednesday at 12:30 GMT. That's 1:30. I mean, in London, 2:30 here in Barcelona and in Europe. So it's a time when usually there's more volume. This time there's a bit less. Okay. Yeah. Okay. So that's all I've prepared for you all today. You're welcome to ask any questions you'd like, either about anything I've presented today or anything else about what we do in the premium service, about any other currency pair. Well, one thing I didn't mention is gold. So I expect gold to rise if we have low inflation figures, because it means inflation is under control. Lower yields, gold needs lower yields to shine. And if inflation is stronger than expected, I expect gold to fall. In any case, gold is in a bullish phase at this point. So, I mean, the momentum is with gold bulls, but yeah. Yeah, so yeah, we got a question exactly about that. Gold rise or fall. Maybe, I guess you're asking about what happens if everything comes out exactly as expected. Then I expect in this case for yields to go just a bit higher, so gold will suffer some pressure, but perhaps that'll create a buying opportunity because things tend to stabilize afterwards. But if inflation is very hot, it's bad for gold. If inflation is very cold, it's good for gold. Yeah, I hope this answers your question. More questions, keep on coming. We have 5 more minutes, and I'm speaking fast, so I can push many questions. Do you think silver has a chance to keep gains this week, and what are the effects of US inflation and interest rate on it? Yeah, good question. Yeah, silver is generally trades in tandem with gold, so the same applies. If it's as expected, I think silver could fall a bit and then rise. I didn't have the chance. You asked a question on the Discord channel. I didn't have the chance. I'll get your question also written, but I didn't have a chance to look at the chart. But I think around the CPI, silver will trade more in tandem with gold. But I'll give you a precise answer with levels to watch and in the Discord channel. Okay. But in general, that's the reaction. Yeah, you're most welcome. Yeah, keep the questions coming. Yeah, another question this month. The dollar should be high. Well, it depends on the data a lot. I mean, if we get super strong CPI, it's the last major event before we get Powell speaking on, probably, it's not confirmed, but usually speaks at Jackson Hole on the 26th. So, of course, there's retail sales and the University of Michigan's consumer sentiment and all these kind of things. But let's say if we get super strong CPI, I think the dollar will close the month higher. If we get super cold CPI will get the dollar closing the month lower. But yeah, there are more events. Sorry for briefing on what you view. Well, I can repeat the 5 scenarios if we have time, and then a recording of the webinar will be available in any case. So basically, I think, just to repeat, the main scenario is exactly focus on core CPI month over month. It's expected to come out at 0.5. Okay, if we get that, I think we'll see some cresting in inflation, and then we'll get more of the same stocks up, dollar up. But every 0.1% makes a difference. Yeah, what's your view on pound dollar? Do you expect more bulls and bears? Any reaction to CPI? Yeah, the pound has been under pressure, and I think it will remain under pressure. The main reason I expect the pound to be under pressure is, well, what we had, those very gloomy forecasts from the Bank of England on Thursday last week, and we're expecting also a negative GDP report on Friday. And of course, we have political uncertainty about what probably Liz Truss will do as Prime Minister if she's elected. Nothing is certain. Okay, so I expect the pound to underperform in comparison to other currencies. And actually, in all scenarios, the pound and the euro to underperform. Can core CPI print lower than expected? What about dollar index? Dollar index, I want to clarify. I mean, I know I repeated many times. Dollar index, the classic one, is 57% euro. Okay, so and then 13% yen, if I'm not mistaken, and a few other currencies. It leans heavily towards European currencies. It doesn't reflect the global economy, but in general, stronger than expected inflation. Then I expect the dollar index to go up. Weaker than expected, I expect it to go down. Okay. The dollar is the most important indicator this month, probably also last month and the previous ones. More important than non-farm payrolls. It's the first hard evidence of inflation. So we get more hard evidence, the PC, later in this month, and we got some soft evidence, soft data, which is surveys. But again, there's a difference between what people say and what people do. If you look at consumer surveys, the situation in the US is horrible. It's the worst, worse than 2009. I mean, when it was 10% unemployment and everything is horrible. And then, okay, so if this is consumer sentiment, then it should show that people are unwilling to buy. Well, retail sales pointed to another picture, including core retail sales and core of the core, the control group. So there's always a difference between what people say and what people do. That's why markets, myself, the Fed, we're all looking for hard evidence. I mean, something that, it doesn't look to the future, but it's evidence of the very near past. Okay, which is the best indicator of any pair? It depends on the pair, but I think now inflation is the most important thing everywhere in the world. So it's inflation, inflation, inflation. If we look beyond that, well, in the UK, in the US, it's Nonfarm Payrolls, and GDP. In the Eurozone, employment isn't that important, but German surveys are important, PMIs are important in Europe. So behind inflation, you can find differences between different countries. In China, industrial production is important. So you can look at many different things, but in general, inflation. Inflation is the biggest market mover, no doubt. IBD, TIPP, economic optimism. This is sort of a more minor survey. I'm looking at the University of Michigan's consumer survey, the Conference Board's consumer survey, and what matters most in these surveys is the inflation expectation component. The same with the ISM Purchasing Managers Indexes. They are business surveys, and what's important there is prices paid inflation. So hope this answers the question. Any more questions coming? Well, I'll take the opportunity to do another pitch of the premium service. I see, I mean, I identify some of you here, but some of you aren't on the premium service. I want to invite you once again to join us. You can tap into our 20 years of experience, leverage our actionable content, learn the best practices from my colleague Tomas, myself, and more experts, and help you become a better trader and enjoy our community. Yeah, can't wait to watch again the recording of the video because it's very deep. Thank you for your work. Well, thank you very much for these very, very kind comments. Yeah, I tried to pack in as much information as I could. Hopefully I didn't speak too fast. I know I spoke too fast, but hopefully I spoke loud and clear so you could understand, and I've been repeating my words. Any more questions before I go? Let me do my small pitch once again and share the link to the premium service. We have 50% off for yearly subscription. That's what our team has been able to organize. Yeah, thank you very much for your kind words once again. Yeah, so anyway, take advantage and trade US inflation. And yeah, yeah, you can follow what we're doing on our Discord channel and Trading Studio for those of you in the premium service, and follow me on Twitter at ForexCrunch, and see all the rest of the content we're doing on fxfree.com. So yeah, here we are. Yeah, we've passed our time limit by 2 minutes. Not a big deal. Anyway, for those of you on the premium service, we'll be covering CPI tomorrow live. Yeah, I guess that's it for today. Once again, trade with care. Remember, it's the most important event now, even more than Nonfarm Payrolls, contrary to what you may have heard. Well, in Forex courses. So please trade with lower leverage. And if you're new to markets, it's preferred to trade on a demo account or just watch it from the sidelines. Okay, so I guess that's it for today. Thank you very much, everyone, once again for coming, and hope to see you soon here, there, and everywhere. All right, thank you, and bye-bye.